A football field away from my house just opened up a new site. They built all these new drive-in lanes. You can like drive up and like put your check in the thing and it like goes. None of us want to do that. None of us care. My generation, everybody younger than me, we all see the signs. Nobody wants to leave their home to do anything.
Whenever people in the past tried to predict what it would be like in the future, where they have flying cars to deliver newspapers, you're totally not understanding it. No one's gonna like, no one wants drive-through banking. They're just gonna go to
Yeah,
online
Tanner,
banking.
it's so dumb.
it feels like that Henry Ford quote. Like if I asked my customers what they want, they would say a faster horse
Oh
because
yeah.
it just seems like a legacy player's idea of the future. How about you just cut out it's not fucking McDonald's. Like they just cut out the drive-through and just go straight online. Like there is
It's
this.
funny because it used to be a KFC and they changed it from a KFC to a smaller bank.
So stupid.
It's so dumb. It's so dumb to me.
SoFi stock is not representing how well they're doing as a company. And that leaves us to have a little bit of alpha whenever we're buying the stock, right? We can buy the company and maybe outperform on what Wall Street thinks of the company because we're paying closer attention. We're going to go back to basics on the SoFi Weekly and explain why we're even investing in this company in the first place before Q1 earnings. And then maybe at the end, maybe we'll talk about what we think about that quarter.
The thought process behind doing a back to basics episode is because Q1 earnings is coming very soon in a couple weeks. And it's just good to revisit the bull case and the bear case, see what the business does from a high level perspective. SoFi is very often a company that you could fall into the weeds with because they have so many different business segments. And all of those segments have new developments and news. And then when you go into Galileo and Technisys, that only is amplified. I think episodes like this will be helpful for people who might be interested in SoFi but don't really know enough about it, and for people who might feel a little bit intimidated by all of these different, business segments and want to learn more. So
Banking has been with humanity for thousands and thousands of years, and it hasn't changed. If you look in the past 20 years when it should have changed, nothing really did change. Yes, we did get shiny, clean looking apps, but all of the technology that you use inside those apps are kind of the same. And we've had this technology for over a decade now. You can check your account balances, you can check your transactions, you can send and receive money, and you can deposit checks through your camera. All of this technology that I mentioned is over a decade old, and it should have changed. Money is becoming more and more technology based. That is going to change the meaning of banking. This is one of the last types of industries or markets that really hasn't been disrupted. And you see all these old banks that have been around for over 100 years, and they all do the same thing. They have old people running them. And I just think, like bookstores and fossil fuel cars, they're going to get a rude awakening sooner or later.
it becomes really interesting when you talk about disruptors and innovators in a legacy space like banking. It is one of the biggest industries in the world and one of the oldest industries. Like Riley was mentioning, I think first bank was Bank of Venice in like 1100, and it doesn't have a lot of innovation, right? The last big changes was
Yeah, in the 60s we introduced computers, and then in the early 2000s we started online banking.
mobile banking, ATMs. I mean, now people are talking about like blockchain and fintechs in general. Having a centralized hub for all your banking through an app. That's one aspect. It is ripe for innovation because it hasn't had innovation. It's a laggard when compared to other industries out there. The second aspect is the fact that it is so massive and so oligopolized. Any country you go to, pretty much, you're going to see maybe 3 to 5 major banking players that have split up the market. And you don't see many other innovators, many disruptors in the space because of that heavy regulation, and the pie has already been split out. It doesn't lead to a lot of competition because people don't have choice. As a result of that, banks are really set in their ways in terms of feeling a need or a pressure to innovate. From a consumer experience, along with government services, because they have no competition, they often make the worst consumer experiences, which makes it even more important for innovators to enter this space. So those two aspects are really the interesting dynamics around banking as an industry, which is set up by this history of banking that we're talking about.
They're just so strong. They have such a moat right now, the large banks, that they don't feel a need to innovate. Obviously, they could go out and get engineers and try to build out better services or even offer a higher interest rate on their checking and savings. But companies like JP Morgan or Bank of America just simply don't need to do that because they just have such a large amount of clients that still want to go into branches. And the truth is that the older clients actually have the most money. That still doesn't mean that SoFi can't come in and try to revolutionize something here.
Talking about what SoFi fulfills in that gap, they started out primarily as a student loans company. That was their bread and butter when they started. Currently, they have several different business streams. The bank charter really unlocked a new stream for them. It's their most recent stream of business. But if we go chronologically speaking, student loans was their bread and butter. And all the way from, I think, 2011 inception, well into the late 2010s, SoFi was primarily known as a student lending company. I think more than 80% of their business was student loans. They also had personal loans and they also had home loans. In 2018 through 2020, they developed and released a lot of the products that would then later become their second business stream, which is the financial services business. This includes products like SoFi Invest, SoFi Money, Relay, SoFi at Work, SoFi Credit Card, which a lot of modern fintechs were offering. The business became segmented. They still had an 80-20 split where 80% was the lending segment, but they were diversifying into financial services more and more. Finally, in 2021, they bought Technisys. Back in 2020, they bought Galileo, two companies that were focused on the tech infrastructure of the banking system. From a technological aspect, making this whole industry plug and play through SoFi's technology, which then formed their third stream, which was their technology segment. And then in 2021, in January, they got the bank charter, which allowed them to be a bank and have this other paradigm of deposits. That's really the history. One of my biggest bull cases for SoFi overarchingly is this diversification. SoFi's entire mission is to be a one-stop shop for all of your financial needs. So whether you need a personal loan or a student loan or a home loan, all the way to opening a new credit card or having an invest product where you can actually invest in the stock market, you can do all of that. That's really one of their biggest value propositions.
The biggest pushback whenever people start getting into that is soon Cash App or Venmo is just going to add all of those products. Or Robinhood, why don't they just start getting into checking and savings? Just get into all those products as well. Start offering everything that SoFi can. Loans, right? That's the biggest one. Everyone's been saying that they are wanting to do this, and no one is stepping up to the plate to offer the one-stop shop. Although they're actually doing something that is completely plausible. A lot of the big banks have gotten there. They just haven't gotten it to a point where they can offer a great level of service to their customers at cheap costs. There's a bunch of different factors whenever it comes to, okay, Robinhood has an invest platform, we have an invest platform. Well, what do we have that Robinhood doesn't have? Well, we have loans and checking and savings and all these things that all sort of bundle together. That's our advantage against Robinhood. So that's why you might choose us over that. And then you go, okay, well, what about the big banks? Why don't I choose a big bank? Because they have loans and all these things. But we don't have branches. So that actually saves us on some of the largest costs in terms of expenses for the big banks. And then we can actually put that money towards higher interest rates whenever you actually sign up for a checking or savings. That's why we have a 4% APY on our savings account, which very little companies can compete with.
The paradigm has been that there will be competition. What we're seeing is SoFi continuously releasing more and more and more products, diversifying further and further away, proactively, aggressively to say, there's more profit here, let's pursue this instead. Or from a defensive position to say, let's not put all of our eggs in one basket with regards to student loans and then have a moratorium. Let's also diversify into these other parts. So the competition paradigm was prevalent, but then as SoFi is introducing more and more products, people are realizing, wait a minute, this is really difficult to do. The bank charter, for example, was one of the prime examples. It's very difficult to get that. It's a whole process. You have to jump through a lot of hoops to do it. So there is some competitive edge there with regards to this diversification, which then further reinforces this moat. When Tannor is talking about a lot of these different benefits against other fintechs versus against legacy players, being the hybrid option, SoFi has the luxury to pick and choose different benefits from either of these different cohorts of players, segments of players, and to offer the best of both worlds.
So when we talk about the all-in-one banking app, this is their kind of cornerstone strategy. Everything behind like their app updates and all their new products, it's going to be content focused, convenience focused, fast focused, and selections. All four of those things are going to make you not want to download another financial app. Why would you if SoFi does it all? We see this with Apple and Android. Android has a lot of cool tech that Apple doesn't, but people still buy iPhones because it's just the easier, more refined version of what a phone can be. That's their strategy, is making everything super content focused, like give you the best content, best convenience, best speed, and then also the most selection of any other app.
It's a bank with a very strong technology focus. They're taking a Silicon Valley approach to an old school idea that is one of the largest industries in the world, right? Especially American finance. SoFi has made it very apparent America is not even their only play, right? We have a strong dominion in Hong Kong. We have registrations for Singapore and United Arab Emirates. And so there are wanting expansions into other financial hubs around the world.
One other benefit, just for people to keep in mind with regards to onboarding more people as a result of them being this one-stop shop and advertising themselves as a hub for all of your different financial needs, there is a network effect very much in play. In other words, similar to insurance, right? In insurance, there's a bundling that happens. If I have multiple products from one company, I can get all of those products for an aggregate cheaper price on an overall basis, as opposed to me having one product from each individual company. This is beneficial for the company because now they sell you 4 products instead of 1. It's also beneficial for the consumer because they get a cheaper price on all 4 products than if they were to go to 4 different companies. This is the same thing for SoFi, because if a consumer is using their invest product and their credit card, and they have a student loan with SoFi and maybe a home loan with SoFi, all of a sudden SoFi has this person deeply rooted into their ecosystem, can give them products bundled for cheaper, or can provide benefits through their ecosystem for this user. And so this is similar to one of the benefits that Apple had with their business model. It becomes progressively more difficult to leave the Apple ecosystem with more Apple products you have, because all of the products are so well integrated with one another. As they introduce more and more and more of these products, sure, today they might be enticing people something that might not be the most profitable for them, even if they're giving you $250 to open a checking account. But in the future, 1 year, 2 years down the line, the ecosystem will do all of the heavy lifting for them because of the diversity of products that they have.
And it's kind of crazy that big banks haven't taken this model of more data, better risk models, better pricing, more products, more customers. You get more cross-sell when you have more customers. When you have more cross-sell on more customers, you have lower costs of acquisition. Like, you get more customers at a lower cost. That more customers gives you more data. But a lot of these apps are so bare minimum. Like, you can't even like sign up for loans in Wells Fargo on their app. You have to go to their website. And it's just so dumb. I really think that a model like SoFi's is going to be way more superior and more convenient for the consumer. One thing that needs to be made clear before we continue is the bank charter is one of the most important things of SoFi.
I would say it's the most important thing that's happened to the company.
Robinhood will not be able to compete with SoFi in the long term because of this bank charter and what it means. Getting a bank charter, which means you get a bank in the eyes of the FDIC, you can operate as a bank in all 50 states, and all you have to be is regulated by the FDIC. And you don't have to worry about all the regulations in each and every state in the US, because before SoFi became a fully chartered bank, they had to comply with all of the lending rules in every single 50 state in the United States in order to be able to lend to anybody in these states, which makes
very
it
costly,
logistically impossible. And now it's simplified all of that. It is really, really, really hard to get a chartered bank in America. This is like incredibly hard. And with this bank charter, we will actually be able to build a competitive moat that other fintech companies will not even be able to touch.
We can't put enough emphasis on this, talking about how important it is and how hard it is to actually become a bank in this current state and environment, especially after a banking crisis, right? We luckily got it just before then, because it'll be much harder. CEO Anthony Noto says that they will not give out another banking charter probably for another decade. Even some of the largest companies that you can think of that deal in large amounts of money don't even have banking charters. Cash App, for example, does not have a fully chartered bank license the way that SoFi does. PayPal has no banking charter. Some of these companies that have massive amounts of money on their books, the margins that they can make will be slimmer to us because then they have to pay a bank to host that money. Now that we have a technology platform, and we'll explain that as well, but we can actually host that money for companies like Cash App, PayPal, Robinhood, or any of these other fintechs that are not actual fully chartered licensed banks. That's one of the best parts about and why I said that the bank charter might have been the biggest, thing that could have ever happened to SoFi Bank.
What advantage that banking charter has for us on just our own lending compared to
Yeah, so
warehouses?
so you kind of said it right there, right? Because we don't just want to invest out our own or lend out our own money because the growth would have people paying back the principal and everything, and then that money would slowly accumulate, and then we'd go lend it out again. The sales cycle would be extremely slow. The way that banks have figured out how to do it is they will go to another lender and say, "Hey, let me borrow from you at a lower rate, so then I can go give it out at a riskier product, but I might have." The metrics on how to do this better than you or something like this, which all of that knowledge for SoFi is all proprietary of how we actually judge a client's risk more than just through a FICO score, also based on their cash flow and everything like this. And then they go out and they get more money from the lent out money. The business was fine like that. Once we actually got the bank charter, like you said, we can now use the customer deposits and it's even better. Now, this is the reason why no bank wants to step in and actually squash us whenever it comes to APY, offering more money in their checking and savings accounts, because that would completely blow out their next earnings results. People are expecting JP Morgan to enjoy all the benefits of the rising interest rates without actually having to increase their expenses. So they are looking like beautiful companies. They're printing money, but they're also losing customers because customers are realizing that they have another place to go. They're able to come to SoFi, and SoFi won't be greedy because SoFi investors don't know any other solution like this.
So, as Tannor was saying, we do have a benefit from the bank charter of providing those loans. We can do it at a cheaper rate than going to another source through the warehouse facilities. That benefit is forwarded over to the end consumer, right? That flows back into the ecosystem. Despite how important profitability is right now, they're actually one of the leaders in terms of the APY that they offer back. That money is going back into the business, it's going back to users. You'll see a lot of these traditional legacy banks, they'll offer you like 0.01%. It's an absolute joke. They can definitely offer you 3%, 4%, but they choose to keep a lot of those profits for themselves because they maximize shareholder returns and shareholder ROI as opposed to the end consumer benefit. SoFi is doing the opposite, right? SoFi is putting that money back into the ecosystem, giving that money back to users, and actually helping with something that aligns fundamentally with their mission.
Yes, I agree with you. JP Morgan can offer 2% in the checkings, but can they go as high as we can? Because of their branches. There are segments of their business that we have just simply material advantages. They have to pay for all the clerks, all the security, all the real estate, everything for thousands of branches across America. And that is going to cut into their margins. SoFi is wanting to improve on a lot of actual ways. Whenever I talk about clerks and branches, SoFi wants to go the opposite way. They want to even integrate with AI and have truly a banking as a service chatbot that'll also help you. They're working on all these different things through products through Galileo and Technisys that are also trying to innovate banking the way other actual industries are being improved by AI as well. So they're trying to stay as cutting edge as possible.
In the example that you highlighted earlier, Tannor, a JP Morgan on a one-to-one basis maybe could not go as high as SoFi because of the legacy branches that they have. But could they be competitive and maybe have some other aspects of their ecosystem be selling points? In other words, this is the biggest bank in America. I want that security. Even if they offer 2% and SoFi offers 4%, I don't want that risk. Sure, I could see that being a selling point. Will they do it? No, because they're not focused on pure growth. And SoFi really is. And I think that really the market cap associated with SoFi does not correspond with the products that they have, with the growth rates that they have, with the trajectory that they have as a business. And it is that variance that we are trying to highlight on this pod. And it really is that variance that is the opportunity cost of investing in a company at this early stage. Because while you are taking a lot of the risk of it being a small startup in comparison to the JP Morgans and the Wells Fargos of the world, what you are also getting is you're also getting the lion's share of that reward for it being at this infancy of its growth rate, because SoFi is actively focusing on that growth. That's why they're giving you the 4% APY. That's why all of the money is going back to the end user, because they're trying to increase and accelerate that compounding of users. That really, in essence, is a huge opportunity, right? Because of all of these things that we said, you're finding out about the stock at such a point where it's crucial, because 5 years from now, that opportunity might already be gone.
The technology platform, like Tevis said, we acquired two different companies, Technisys and Galileo. So Galileo was the credit card processing unit for, originally we wanted it for SoFi, right? So whenever people actually use their debit or credit cards, that processing would actually be done by Galileo. Well, Galileo also deals with a lot of really big names that not a lot of people actually know, like Chime, MoneyLion, Dave, Robinhood. We actually help these companies, 131 million other accounts are also on Galileo's platform. Not only will companies like Robinhood and all of our competitors also have to pay those margins. So now they're paying for fees to host their money at a different bank, and they're also having to pay fees to a processing company to actually allow their clients to swipe their cards. This is another advantage that not only does SoFi get for free because we're both a bank and have that processing, but also we take money from our competitors. Technisys, same thing. They wanted to build the underlying website developer. Obviously, it's more to that. It's the core banking software and the ledger, which is banking jargon for having the back end of entire banks actually be set up by our process as well. Once again, acquired to do SoFi's own bank, but also to offer it to other banks, as well as integrating that with Galileo, and bundling these two things together will beat out the competition for both of those things, because we actually have something that not a single other company in the entire world has. There's not a single other banking as a service company that allows for the back end of a company with also a payment processor, and then also the ability to have a bank on the back end to actually host the money for you.
Being vertically integrated as a bank is going to allow more innovation on the front end side that you don't see on the back end side. So this is going to allow SoFi to be way more agile and way more innovative in the long term.
That's really the next thing that we should talk about, is the vertical integration. The cross-selling of their products to their consumers is obviously one of the bull cases for SoFi being a one-stop shop. The vertical integration is the second bull case for SoFi.
You should explain vertical integration.
Yeah, so vertical integration, think of a car assembly. Instead of, let's say, Ford getting all of the parts from different sources, different manufacturers, assembling it and shipping it out as one finished product, they would make all of those parts themselves. This obviously goes into extremes. For example, Tesla has gone all the way to the mining of the raw minerals that then get processed into the parts that then are assembled, that then are shipped out. And so fully vertically integrated. Instead of going horizontally to many different suppliers, they go vertically to own every step of the process from inception all the way to delivery. What does this mean for SoFi? It means that for all of their product lines, they aim to do it in-house in a sustainable way. By doing it in-house in a sustainable way, they're cutting out a lot of these different partners and a lot of different suppliers. Why is this important? Well, it means that they can keep a higher share of the profits from all of those different streams. In addition to Galileo and Technisys, the third tech company that SoFi owns is Wyndham Capital, which they just announced the acquisition of a couple of weeks ago. This is an important point on the vertical integration, because SoFi, they're approaching vertical integration from what they're deeming their cores. What do these mean? This is their core technologies that power their solutions for different product lines. One of their cores is credit cards, home loans is another core. By bringing all of these technologies in-house, they can not only make a higher profit on the business to consumer side for the end user, but they can also sell it for cheaper and actually be competitive because they're vertically integrated. However, by being vertically integrated, they not only have more flexibility, more control, more profit, and pricing power, but they also can sell this to other businesses as well through the Galileo infrastructure. So this technology that they vertically integrated, they can actually productize, white label, and provide to other businesses in the industry. And going full circle back to the start, we know that banking is one of the biggest laggards from a technological infrastructure perspective.
And they're going to have to change regardless into the future. The CFPB, the Consumer Financial Protection Bureau, ago, has been leading the move for the US government into open banking. And the US government is set on moving us to open banking. And whenever it does happen, and eventually, banks will have two choices. They can go to SoFi and get everything already made, or they can do it themselves and waste a lot of money when all of their moats are being reduced because it's easier to move money to another bank anyway.
We're creating almost like a CRM or like a true SaaS product, but it's for banking. It's banking as a service. Once we actually get those clients, it would be very hard to move off because that integration is very much there. And if we can offer that service, like we said, payment processing, the banking as a service in total, and then also hosting your money, once again, that's the same thing, opposite of their own app, but still very sticky, very hard to leave. Some of our key performance indicators would be our members. As every single member in finance uses our products, they continue to use them once we actually get them for the most part. They get a credit card, they continue to spend it where they can. They get a checking account, they host money, they set up direct deposit, it's continued money. They buy their stocks, they do every sort of thing that they can possibly do. That's the cross-selling nature of why we have so many different products. These are products, they're not 7.9 million different products. This could be 7.9 million different checking accounts. It's not different products, it's how many people have credit cards, checking accounts, personal loans, student loans, every single product that you could have in the SoFi app. So if one user, one member at 5.2 million of them has a checking account, a credit card, and a personal loan, that's 3 products. So that would contribute to the product section. That's how we kind of know as we're gauging that people are cross-selling more and not just coming for one specific product. Invest product, their whole platform for buying and selling stocks, also includes options, fractional shares, or margin accounts, which increase the actual monetization of that product. That would still be considered one invest product. Financial services has been an amazing boom. 3 years ago, from Q4 2019, only having 387,000 to 6.5 million users on our financial services. This is because obviously we became a bank and our checking account, our invest products, they work so seamlessly together that a lot of people are signing up for it.
This financial services productivity loop is really the reason why financial services products are growing much faster than lending products because of this cross-selling. SoFi, while historically might have started out as a lender, there's barriers to entries. For student loans, home loans, personal loans, generally, they're in the tens of thousands, if not hundreds of thousands for those loans. Whereas for an invest product, for you to open, let's say, a stock trading account, you can do that with $100, $200, $1,000, $2,000. And so it's easier for people to onboard onto these financial services products than it is for them to onboard onto the lending products. What you can see in this middle chart right here, the bar graph from 2020 all the way through 2022, the ratio has increased. So there are more people on financial services products than there are on lending products, because it's so much easier. Of course, SoFi doesn't make as much money on, let's say, an invest app than they do on a mortgage or a student loan. But if we look at this slide, as more products get released by SoFi, with those products being easy for people to onboard, that productivity loop is going to accelerate more and more to the point where SoFi is going to diversify all of their product offerings. And you're going to see financial services growing even faster in subsequent quarters than the ones previous.
How is this translated into real dollars and cents? Well, as you can see, year over year, we're still growing at about a 50% rate from 2021 to 2022. This is something that is an easy way for investors that don't look into the company to trash on SoFi, is that we love talking about the company whenever it comes to EBITDA. This cuts out things like stock-based compensation, depreciation and amortization, a bunch of these really, really large costs for SoFi that are real. Like, don't get me wrong, we don't want them, but they're actually not real charges. They're non-cash charges. It hurts as an investor, but it doesn't hurt as the survivability of the company. So during the banking crisis, when a bunch of these small regional banks were actually collapsing, people were wondering if SoFi was even going to be alive. And the reason why we love EBITDA so much is because what it's really showing is that we are not in a cash burn situation. SoFi is very much staying alive and they're still paying the bills, keeping lights on, and actually putting more towards their cash versus debt on their books. Anthony Noto, the CEO, has also said that we should be GAAP profitable by Q4 of 2023. That's been something that we've wanted to see. and it's going to be happening. A reason why we love this company as well is it's been triple beats across the board. Whenever I'm talking about a triple beat, what I'm talking about is the top line, the revenue, how much they're actually bringing into the business, the bottom line, how much they're actually taking home. The third column, I guess, would be guidance for next quarter. SoFi has done triple beats and double beats across the board since they've been a public company.
Absolutely. And you have to keep in mind that Anthony Noto, he has a pretty solid pedigree of experiences with analysts and with the public markets prior to SoFi. I mean, he was at Goldman Sachs, he was at Twitter, he was at the NFL. He's worked in CFO positions in the past, COO positions, all around the C-suite. When we talk about profitability, there's really a couple of key factors. And here's where we get into more recent pieces of news, more recent pieces of information. One of the key things around their diversification was the reasoning and the rationale why they were doing it. Student loans was basically kneecapped because of the moratorium in March of 2020. Hey, we have an emergency because of COVID. We're going to pause repayment on student loans. That's been the case all the way up until now. As a result of that, SoFi has had to really be nimble and agile in diversifying their product lines. And they've done that effectively to the point where financial services are now a bigger portion of the pie when it comes to their EBITDA. However, financial services is still their only unprofitable segment. Loans is profitable. Technology segment, Galileo, Technisys, this is profitable as well, albeit they had a little bit of a margin hiccup in Q4, which we expect to be resolved. The caveat here is in the Q4 earnings call just a couple of months ago, SoFi management said not only that we will be profitable by Q4 of 2023, like Tannor said, but financial services will also be profitable. So all three of their business segments will be profitable by that time. More overarchingly, their expenses were quite high due to the stock-based compensation. Stock-based compensation is a reality for smaller companies because the smaller companies essentially want to vie for the top talent, and they have to shell out a lot of money in terms of stock-based compensation. One of the biggest bear cases that SoFi received for a long time was stock-based compensation as a percentage of their revenue, so their top line. That stock-based compensation eventually gets paid out and their revenue keeps rising. And so as a percentage of revenue, stock-based compensation is starting to fall in a big way.
Yes, it's because we're making more, but actually in absolute dollars, we are actually paying less whenever it comes to stock-based compensation as well. It's been 2 straight quarters in a row. The purple is actually dropping. So in the last 2 quarters, we're actually seeing a decline in stock-based compensation. And then in this, once again, annoying orange color is the stock-based compensation as a percentage of revenue. Maybe I can, yeah. So lately it was 15.54%. But at the absolute top, it was 27%. If you compare that to the actual competitors, it's unbelievably high. Okay, that was a massive issue. But not only is it dropping, like you said, because our revenue is growing, but it is also dropping. They are actually spending less.
And you put those two things together as a percentage of revenue, that line goes down even quicker, right? And so this is also something that is becoming increasingly positive. SoFi has deconstructed that bear case essentially through the last recent quarters. We expect both of those to keep going down into the end of the year, which also are going to contribute to the company's profitability.
Obvious to say that Anthony Noto, the CEO of the company, is bullish. Palantir is a great example of someone that talks a great deal about how great their company is. It might actually be a little bit different. He's selling stock. He's not buying anything, even though he says it's a 10x value from here. He's not doing anything with his own dollars. Anthony Noto is not one of these posers. He puts his money where his mouth is. He's been buying millions of dollars with his own money. Look just here in December, this man was on a buying spree for this company. And this stock was on a free fall, but he's been buying it ever since it was almost $10. Once it hit under $10, it was below the SPAC price. He immediately started to assume that this stock was undervalued and buying more. Now he holds $37 million worth of this company and, could potentially continue if he can keep writing checks like this, which who knows where he's getting this money because he's not selling his SoFi shares to buy SoFi shares. This is his own cash purchases, has nothing to do with performance-based stock units or anything along these lines. These are cash purchases.
It's obviously bullish as a standalone fact, even more bullish considering that the macro economy of where it is, CEOs have been selling left and right. And a lot of them have been proven right. We had the biggest CEOs of the FANG stocks all sell in October or September of 2021, which was the peak of the market. And even in bank stocks throughout 2022, many of the CEOs have been selling. So not only have they not been adding, but they've actually been selling. The fact that Anthony Noto has been DCAing all throughout the year, every couple of weeks, especially when the stock was towards the bottom in November, December, is bullish, but even more bullish in the context of the wider market with what these other CEOs have been doing.
Anthony Noto is making a bet on the future on two things. The AWS model for banking as a service, SoFi is trying to build out, is going to be a winner. That's what Anthony Noto is betting on. And then also the one-stop shop, all-in-one banking app is his bet on the future as well. SoFi's strategy is always going to be way more different than the traditional banks. And I think Noto understands that because he's been an analyst, a banking analyst. He's probably seen the way banks work, and he's probably had a lot of questions about why they don't change things. And he probably realizes that you can't. Anthony Noto sees that opportunity, and that's what he's betting on. He's betting on the future of the market that he's trying to build.
Well, there's also one other aspect to consider, which is very simply that when you consider performance stock units, the restricted stock units, and the cash that he just has, that he has been put into SoFi, a huge amount of this man's net worth is tied up in this company. So while it is true that he is betting on the AWS of fintech and he is betting on, more innovation in the banking sector, he's betting on himself.
Yeah.
SoFi is the one company in the market that he can directly control the outcome of, not the S&P, not any other individual name. He can control the outcome for SoFi. And ultimately, as an investor, that's what I want to see. I want to see not only a CEO who actually believes in themselves, but a CEO who actually puts their money where their mouth is when it comes to these types of investments, right? Because Anthony Noto has said time and time again that this company is what he wants his legacy to be, is what he wants to be known for. And the financial backing that he's putting towards SoFi, he's doing it just because he can control the outcome of that company fully. And so
Yeah.
you don't want to bet against somebody like that, I don't think.